almost every cyclical market is tenant friendly, and the landlord has no rights.
Yeah.
The landlord is the big evil capitalist. Okay?
Yeah.
And the tenant is innocent of everything, of course, right?
Yeah.
They never ruined a property. They always pay their rent. The court doesn't even care if they pay their rent. You go to court in Los Angeles, and it's an uphill battle.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. I am here with Jason Hartman. He is the CEO of Empowered Investor and also the host of the Creating Wealth Show. Jason, thank you for coming on the show.
Hey, thanks for having me.
Yes, I first heard of you years ago, and I remember sitting around with my buddies and watching one of your YouTube videos, and this was during the time of basically free money. Interest rates on, I think, homes were 2.5% or something to that effect. And you said a statement that I will never forget. You said, interest rates are the cheapest that they have been in 5,000 years.
Yeah.
And I remember thinking to myself, well, this is ending right now, and I should have been borrowing massive amounts of money, and I wasn't.
Right.
Maybe kind of give us a brief overview of what happened that we lived through.
Yeah, sure. So, during the COVID era, we saw historic easing, money creation, just super easy money. And by the way, that's not hyperbole when I said we have the lowest interest rates in 5,000 years. It's actually true. Great book I want to recommend by the late David Graeber. Never got to interview him on my show, and he passed, but it's called Debt, the First 5,000 Years. I'd highly recommend it. It's a really interesting read. I've read it a couple of times. And so we have these super low interest rates, and it was literally a negative interest rate environment because the rate of inflation was higher than the rate of a 30-year fixed rate mortgage in the US. Yeah. And so it would just be crazy not to borrow as much money as you possibly could under those circumstances. What many people don't realize is they think the house is the asset and the mortgage is the liability. But the mortgage is actually the asset. It's one of the best financial assets ever. And this is true when rates are, lower, obviously. But it's still true now, okay, as well, even though we have higher rates. And the U.S. is a very unique market in all the world because basically mortgages are backed by the government in the U.S. They're subsidized. So a lot of people like to complain that, hey, I hate welfare, the government's spending too much money, giving it all away to people that aren't working and so forth. Well, if you want to get in on that gravy train, be a real estate investor because you're basically getting government welfare through the subsidized mortgages. Yeah, it's incredible. It's an incredible opportunity.
Yeah, you mentioned before we hit record that you wanted to connect the commodities market and the real estate market. What do you see in there?
So we're at a commodities conference, right? A lot of precious metals people here, a lot of gold bugs. And, I'm not a huge metals fan. I think they're okay. They're a form of insurance and everybody should have a little bit. But the problem is that you can't leverage it. You can't rent it out. It doesn't have the unique multidimensional aspects that a real estate investment offers.
Yeah.
And so that's why I like real estate. But I actually kind of hate real estate in some ways. And here's what I mean by that. I know it may sound funny, but I created a strategy 21 years ago called Packaged Commodities Investing. And I actually trademarked that, Packaged Commodities Investing. I also call it assembled commodities investing sometimes. But what it basically means is, when you buy a house as an investment, and I love single family homes, by the way, but I've owned a lot of categories, mobile home parks, large apartment complexes and so forth, but single family is my favorite.
Okay.
Anyway, what you're really buying is the ingredients to the house. So think of it. What are the ingredients that go into a house? Copper wire, a commodity.
Yeah.
It's globally traded, not attached to any one currency. It has intrinsic value regardless of anything else. It's valuable. Copper is valuable. Okay. Petroleum products, copper, copper wire in the walls, right? Petroleum products all over the house, glass, steel, concrete. There's all these ingredients, right? And so I created something called the Hartman Risk Evaluator. And basically what it does is it helps people minimize any downside risk on a real estate investment. And it does that through, we've all heard of the LTV ratio, the loan to value ratio, right? Everybody knows what that is.
Yeah.
But I created a new one called the LTI ratio. And you got to remember, when you buy a property, you're not buying one thing, you're buying two things. The two major components are land and improvement. In other words, the structure, the house, the apartment complex, whatever, sitting on that land. And that improvement is made of all these ingredients we just talked about.
Yeah.
So you are a commodities investor. And look, you can invest in those without calling them real estate, right? You could buy those on the exchange. You could buy copper. You could invest in all these commodities, basically lumber, of course, right? But the problem is you can't invest in them on the exchange with a 30-year fixed rate mortgage that you can outsource the debt obligation to someone else called a tenant.
Yeah.
Okay, it's a beautiful formula, this equation.
Yeah.
So you're owning these commodities. Now you do own a little, remember the two components. You do own some land. Land isn't one of those commodities we talked about. So what we try to do is minimize land value. In other words, buy in cheap markets, inexpensive markets mostly,
Okay.
and then maximize as a ratio, as a proportion, the improvement value. So when you look at the overall equation, maybe the house costs $400,000, and 20% of that is land value, 80% is improvement value. The improvement is just all those commodities.
Yeah.
You're a commodities investor. You're not really a real estate investor.
Yeah.
Most people would call the real estate the land. That's only 20%.
Okay.
The commodities are 80%. That's the biggest thing you're investing in. But you get to finance it. You get someone else to pay the debt on it. You get tax benefits. It's the most tax-favored asset in the country. And it's got these unique multidimensional characteristics.
That's impressive what you're talking about. Okay, so a packaged commodities investing. I
Yeah.
like that. And
It's a mouthful.
Yeah, and land and improvement, and that makes a lot of sense too, because most of the value is coming from the drywall and the framing
Right.
and the copper pipes and
Yeah.
everything
Yeah,
inside.
well,
the house.
copper wire. There's not many
Copper wire.
copper
Yeah,
pipe
you're right.
houses
Yeah,
anymore.
not anymore. Yeah, it's
Those
all
are a
glass.
real premium. But they
all
say those are
plastic
better.
now.
Yeah, it's all PVC nowadays.
Yeah.
Yeah.
Um,
But what that begs the question, right? You want to, if you invested in, say, California real estate, this doesn't work, because in California real estate that equation flips. The LTI ratio is mostly land and less improvement. In fact, in some areas it basically flips 80-20.
yeah.
It goes 80% land, 20% improvement,
Yeah.
whereas we like, and these are rough numbers, obviously it varies a little bit,
Yeah.
but we like 20% land, 80% improvement, because then we're more in the commodities space.
Yeah. Yeah.
Why do we like that? Well, I'll tell you, because the commodities, they have a floor, right? They'll never be worth nothing.
Yeah.
Now, you could argue the land will probably never be worth nothing either. But in these high value markets, they're what we call cyclical markets. So if you're looking at a chart of appreciation over time, the cyclical market's like a roller coaster, okay? It's crazy ups and downs. A linear market with low land value kind of looks like this. It's a much more even keel type of thing.
Okay.
It's not radical, it's not speculative. They have good cash flow. The rent to value ratios are very favorable to the investor. That's the difference.
Okay. Okay. My favorite investment, actually, and it's funny, I have a show on commodities and,
Yeah.
and like that, but
I like commodities. I'm a commodities investor.
Yeah.
And they're part of all my houses.
Yeah, my favorite investment is actually cash flowing real estate.
Yeah.
Because it's I started I don't know 20 years ago or so, and it is really nice to just get a check every month
Oh, yeah.
and have someone pay down your mortgage.
Yep.
What should investors be looking at now if they're looking at cash flowing real estate? You already alluded, don't go to California.
Yeah,
Right?
or any high price market. Right?
Okay.
So, it's a huge country.
Yeah.
All real estate is local. There are nearly 400 metropolitan areas in the US. There are over 3,100 counties, over 9,000 cities, countless neighborhoods.
Mhm.
Okay? All real estate is local, it acts differently. But for efficiency's sake, you can kind of divide these into three major types of markets:
Okay.
linear markets, cyclical markets, and hybrid markets. So the cyclical markets are the ones that get the most attention because they're the most interesting to report on.
Yeah.
Large gains, ugly losses.
Yeah.
Okay, they're cyclical, like a roller coaster.
Like Austin or something, right?
Well, like Los Angeles.
Oh, okay.
Okay,
Yeah.
yeah,
Okay.
that would be, any market with high land value is going to be by default a cyclical market.
Okay.
So think of the areas in the U.S. The expensive northeastern markets,
Yeah.
the West Coast, and then South Florida.
Yeah.
Okay,
Okay.
those are the so. And when I talk about the expensive northeastern markets, some markets in Connecticut, Boston, Washington D.C., New
New
York
York.
City, definitely, right?
Yeah.
Washington D.C. less so, but yeah, it's crazy. It's very speculative. The rent to value ratios are terrible in these markets. You can never get enough rent to make the deal make sense.
Yeah.
Okay,
Yeah.
so then we contrast that with the linear markets. The linear markets are most of the rest of the country.
Okay.
Almost everything's a linear market. There are way more of those than there are cyclical markets.
Okay.
Okay, around the world, it's the same story. This is a worldwide phenomenon. So think of the cyclical markets around the world, all the trophy cities: London, Paris, Dubai,
Yeah.
Hong Kong. Right? Those
Yeah.
are the crazy cyclical markets. Tokyo.
Yeah.
Okay. Most of the world is a linear market. Most of the country is a linear market. Now there are some that are in between, and those are the hybrid markets.
Okay.
In the U.S., those would be places like Austin, Denver. Those are kind of in between the two. They're not too extreme either way.
Yeah. Yeah.
Yeah.
Okay. And your recommendation is linear or
Linear or hybrid,
okay?
not cyclical.
Not cyclical.
Yeah.
Okay.
Cyclical, if you're a speculator and you like to take huge risk, a cyclical market.
Yeah.
Okay.
Yeah.
Now, some people watching this or listening to this could be saying, hey, I bought my house in Los Angeles and I made a lot of money on it. Jason, you're wrong. Well, no, they just got lucky
Yeah.
because they entered at the right part of the cycle and they rode it up and they made some money,
Yeah.
right? But I'd rather be lucky than good. Or, yeah, I'd rather be lucky than good, right? But unfortunately, I can't depend on luck.
Yeah.
So you just have to be good.
Yeah.
And the older you get, the more conservative you usually get with your money because you just don't want to have to earn it again if
Yeah.
you lose it, right? And so these linear markets are nice, safe, solid markets where the investment is sustainable and it makes sense.
Okay. Okay. All right. So three different markets. You got linear, which is most of the planet. You have
Yeah.
cyclical, at least in the U.S. An example would be like the Northeast,
Yeah.
the West Coast, and
South Florida.
South Florida.
Yeah.
And then you have hybrid ones. A couple examples you gave were like Austin and Denver.
Yeah.
You avoid the cyclical ones and you focus on linear and possibly even hybrid. And
Yeah.
that's where you found the safest bet to place,
Absolutely.
and that's where you make your money
Absolutely.
and you preserve your capital.
Now there's one other dimension. Now
Okay.
that we've outlined that,
Okay.
we want to, as investors,
Mhm.
we want, and we're landlords, okay? So we want to invest in landlord-friendly markets
Yeah.
where the regulatory climate is favorable to us. If we get a deadbeat tenant and we need to kick them out,
Yeah.
we want the courts and the legal system to support us
Yeah.
in that, right?
Yeah.
We want contracts to be enforced so we
Yeah.
can rely on things. Well, interestingly, almost every cyclical market is tenant friendly and the landlord has no rights.
Yeah.
The
Yeah.
landlord is the big evil capitalist, okay?
Yeah.
And the tenant is innocent of everything, of course, right?
Yeah.
They never ruined a property. They always pay their rent. The court doesn't even care if they pay their rent. You go to court in Los Angeles, and it's an uphill battle.
Yeah. You're right.
It's very hard to get favorable treatment as a landlord. But you do that same thing in Alabama,
Uh-huh.
and it's a totally different story.
Yeah.
Okay, that's a market where the regulatory system expects tenants to do their part.
Yeah. Yeah.
Okay? So,
Yeah.
yeah.
I found that I live in California, and my buddy and I have been looking for rental properties, and it makes sense why the math hasn't made sense
Yeah, nothing
for
makes sense
years.
in California.
Yeah. But I have rental properties in Vegas, and it's just like you say.
Yeah, right.
If they don't pay, then it's 7 days, pay or quit.
Yeah, you're out.
Yeah, and I feel like we're doing a good thing. We're providing homes for people.
Yeah.
I think that's good.
Yeah.
Okay, thank you very much. If viewers want to get a hold of you and follow your work, how can they do so?
Yeah, so my YouTube channel, just type Jason Hartman. Any podcast platform, just type Jason Hartman. You'd see the Creating Wealth Show. Or my main website, jasonhartman.com. It's all real easy, just my name.
Okay,
Yeah.
all right. We'll put your links all down below. Jason, thank you much
My pleasure.
for coming on the show. This was kind of a bucket list for me, so I
Absolutely.
appreciate it.
That's great. Well, happy investing to you and everybody listening.
Thank you. Thank you. And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful day.